All right, enough from me for this week. Let's move on to the weekly regular portfolio segment in the Resource Edge, where I will talk to viewers of this channel, regular folks with normal portfolios. As always, you're welcome to send me an email at antonio@resourcetalks.com. I'll happily host you as a guest to talk about your portfolio and what you invest in, what you don't, what you love, and what you hate. And this week, I spoke to a great guy by the name of Michael Hyatt, who is 52 years old. He's ex-Deloitte employee, now turned cybersecurity entrepreneur. He's living in Australia, recently bought what he calls a little farm, though as a city boy, I don't deem that to be little at all. But he told me all about himself, what he likes, what he doesn't, what he invests in, and what he does not. So let's play that clip on here. All right, Michael, you're from Australia. That's pretty much the only thing that I know about you. So why don't you tell me a little bit more about yourself? Who are you? How old are you? What do you do for a living? All that type of thing.
Sure. So, yes, I'm Australian. Born and bred in Tasmania. So, you know where the Tasmanian Devil's from cartoon fame, Tassie Devil. So I was down there, moved to Melbourne 11 years ago. I was a director for Deloitte and had an opportunity to come up there, so I moved, and my wife was really keen to move to a bigger city. That was from Hobart, which was a big country town in Tassie, really. And then moved, actually probably 2 months ago, moved to Queensland. I bought some property up here, about 41 acres.
Wow.
So, yeah, I've always wanted to do that, always wanted to farm. So now I'm in the country rather than in the city. I had a gutful of the city, particularly after Melbourne's lockdowns over the past few years. So, my background is economics. So I did an economics degree and an information systems degree at uni, and did economics for some time, business, risk, that sort of thing. And then I did a master's in cyber security. So now I'm a partner in what's called an insurtech firm. So what we do is provide technology and services to the insurance industry. So we've created, over the past several years, we've created a new suite of cyber-based insurance products, particularly focused around data, carbon credits, digital assets, that sort of thing, but for total loss, which doesn't exist right now. And that's a pretty exciting area that I work in.
Okay.
So yeah, that's I guess me in an elevator pitch.
41 acres. Wow, that's 160,000 square meters, I guess.
Yeah, it's pretty close. It's about, yeah, that's right. So it's a bit over 16 hectares. So yeah, it's about 165,000 or thereabouts.
165,000. If you say that the average apartment where I'm at is about 80 square meters, that's about 2,000 apartments. It sounds pretty cool when you say it like that.
Yeah, that's our granny flat, 80 square meters.
But it's crazy. I would watch these things in the Discovery Channel about Australia, and like a farmer would drive for like 3 hours and he'd still be on his own land. And
yeah, look, we're surrounded by. I'm in a place where there's some big commercial farms, and yes, and just north of us, probably about 2 hours north of us, there's some big cattle farms, and yeah, they're measured in square kilometres, not square metres. So there's some big farms around us, but that's too much for me to look after. I just wanted basically a bug out, a place that it's beautifully peaceful. You've got kangaroos running around and wedge-tailed eagles and all sorts of wildlife, and I love it. It's peaceful. It's something I wanted to do for a long time, and finally I've done it. Yeah.
Happy to hear that. So,
yes.
How do you get around though? Do you make any money off that land, or is it mostly your job that earns you your pay?
No, I definitely will. The plan is to live here, but also build up to about 6 cabins, about 80 square metre cabins in your parlance for your apartments, and then to do an Airbnb type thing. So that'll help pay for it. I'll put in an orchard already, probably put in another orchard. We've got chickens and ducks and guinea fowl, probably get some goats. So I think I'm really of the thought of being more and more self-sufficient. And look, if being in Melbourne lockdown over the pandemic period taught me anything, it was I want to be independent of the state as much as I possibly can be, and this is my way to do that. I sold a house down in Melbourne, and essentially the property that I bought here, I bought it, so I didn't even come up and look at it, I just saw it online, said, yeah, that felt good, just bought it. But it was less than half of what I sold my house for. So we own this outright. There's cash in the bank. I was able to invest, buy some more stocks, and things like that, and things that I've been doing over the last several years. So it turned out nicely, and we'll build our house here. It's going to take a little bit of a while to do that, but we're in a nice little cottage here to keep us safe and sound while we do that.
Nice. You still make most of your money through your job, though. Are you comfortable with sharing what the ranges are for someone in your position?
Yeah, because I'm a partner, we basically we have our remuneration is pretty flexible. So 6 figures, so 200 to 300 K a year, and then there's stocks on top of that, or ownership in the business on top of that. So, but it ebbs and flows. When you're in a business of your own, it ebbs and flows. Sometimes the cash has to go into what you're investing in. So we take, there's times where I haven't drawn any salary whatsoever. I've lived on my savings up to 2 or 3 years because we wanted to pour it into what we were doing. And that's just the life of an entrepreneur. And that's why I guess so many people don't do it, because it can be quite taxing sometimes. But the money I made in Deloitte and other things that I did prior to joining CIS as a partner, that money was saved and put into precious metals. And really, I didn't start stock stuff until early 2020. In fact, it was just after the March crash in 2020. I probably started in June, so I missed the bottom. But in some stocks, I've already hit that bottom now and bought at some good discounts. So I wasn't in the market much before then. So I've only been in it for a couple of years.
Lucky man.
Real estate, I've had real estate before and built up that portfolio. So it's something that's done over time. I'm 52, so I've been in the game for 30 odd years. So like yourself, I'm a saver. I like to save and put things away for a rainy day. And when you do that over that period of time, you can accumulate some assets and be in a good position.
Yeah. So
really, at the end of the day, I could retire if I wanted to, but I don't want to, because I want to continue doing what I'm doing because I enjoy it. It's not taxing me. If I got sick of it, I could just say, no, I'm just going to sit in the farm and ride around on the farm and do what I want here and play the stocks.
I mean, you look to me like you could use a little bit more stress, because if you're 52, you've got all your hair. You don't have a rib. You've got nothing in your forehead.
Salt and pepper.
A little bit, yeah. But you look perfect for your age, man. What percentage of your portfolio? What is your portfolio breakdown? If you had to, could you do in percentages?
Yeah, look, I've stuck to thirds. Third. So a third of my portfolio is real estate. A third is precious metals, physical precious metals, and that's mixed between vaulted and even kinesis. I have a bit in kinesis, and that helps with liquidity. Fast enough if I want to do it. The other thing I really interested in kinesis was the card that you use, for transacting things, and a third in equities. So that's essentially how I spread my major portfolio of the world portfolio, if you like.
Okay, well, let's talk about that part. Equities is the most interesting part to me. Is that all natural resources? Is it growth stocks? Do you have dividend? How have you split your third of that goes into equities?
My portfolio now, I'd say I'm about 72% uranium in my equity portfolio. The rest is made up of silver and gold, and battery metals. So lithium, and I'm got there's a company in Australia, QPM, which is Queensland Pacific Metals. They a nickel. They're a nickel play. They're not a miner, but they have a technology that's amazing. A green technology for that battery metal. So I've put some money into those, and I think they'll do pretty well. That's a real long term one. That one, it's like put it in the bottom drawer and leave it there and pull it out in 5 years. But what I bought recently, I had before, but I've just gone bigger into those, and that was Bannerman and Deep Yellow. And I also took some exposure to the fuels, so Centris and Lightbridge. And so I bought some of those to get some access into, on the fuel side, because I thought, it'd probably worth having a punt in that area. Generally speaking, I look at my equities are not diverse. Doug Casey would say, no, they're all pretty much commodities now. I've sold out my biotechs and that sort of stuff. And I'm just straight commodities, mostly uranium. Because I think it has the best upside. But I'll start rolling out of that when we start seeing the profits and moving into agriculture and precious metals in the near term. And I think in the next 12, 24 months, we're going to see some fireworks in uranium. And I think the precious metals will be delayed slightly, but I think I've got some exposure there now, but I intend to add more exposure there in the equities in the next 6, 12 months. But the other two that I really like, 92E in Athabasca, who's an explorer, and T92, just listed on the Australian Stock Exchange, Terra Uranium, which is also an Athabasca explorer. So with my uranium, I've got Cameco, so I've got some producers, but my biggest portion would be developers, and then the next would be the explorers, but they're all spread out. I've got Athabasca, I've got US, Namibia, and Australia. So they're reasonably all spread out. But I'm pretty, I got into Age, which is Alligator Energy, very early. In fact, that was my first uranium stock. I got into there at less than a cent back in, I think it was 2020, 2020, later 2020. And I've kept on with them. I've actually bought more of those and hold that. They have some pounds in the ground, but I like a good spread. Most of mine have JORC resource, which means that they've got the pounds in the ground, whereas your 92E and your T92, they don't yet, but they're in a good spot. And I know 92E have really had some good results of late as well. So they're our really specky ones that I think, if they go, they're going to go like a cracker. So I'm pretty confident. And look, just to let you know, with these massive pullbacks we've had over the last few months, and I was well into profit in my portfolio. With the big pullback we had, it went into the red for the first time. And I remember you saying a couple of times that yours was still in the red. And I'd never been in the red before, and it was red, and I was probably red for a while, but I'm back in positive territory now.
Wow.
But I never lost an ounce of sleep because the fundamentals are just so good. I could sit on this. I guess I don't have a mortgage. I don't. What it costs me to live is not much. I don't drive around in Lambos and frigging this, that, and the other. That doesn't really bother me. So it doesn't cost me much to live. And so I guess because of that, I don't have to draw down on my equities for my lifestyle. So it doesn't bother me if they're going down or staying down for a while. I just know the fundamentals are good, great, and so I can hang on.
I agree. I'm still in the red, by the way, but I'm not losing any sleep, and I'm adding wherever I have the possibility to do so. So that's a good message. As long as you're confident in the thesis, why would you worry? What if I give you the hypothetical question that I always give sort of at the end of the conversations, if there was a gun to your head right now? Because you said you're not too diversified, but you are rather diversified. I mean, you have a couple of dozen stocks, I'm assuming, total, if you take everything together.
What's that? between 30 and 40 stocks a lot.
Well, yeah,
That's
there you go.
Australian and North American, yeah.
Yeah, so that's not nothing. What if there was a gun to your head right now and you had to sell all of those stocks and just buy 3 stocks and that's it with all that money?
That's a tough gig, but Deep Yellow, I would keep Deep Yellow because I think John, he's been there, done that. He knows what he's doing. He's got an excellent team around him. I had Vimy shares when we got taken over by Deep Yellow. I had Deep Yellow shares as well. So, yeah, definitely then. Bannerman, I'd keep Bannerman. And I'll sort of, I think Brandon's an amazing guy, an amazing manager. Very impressed with him. So those two, and I guess, I'd either be, well, do I go the easy way and go, okay, keep Cameco because Cameco's going to be cash cow, yada, 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 and pay nice dividends. But I think I'd take the risk. I'd take the risk on 92E.
Okay.
I think 92E, I would, they're the 3 I would keep.
So all uranium? You're not going to take anything else?
Yep.
You just, okay.
Those 3.
Okay.
All uranium.
That's strong.
Spiky rocks.
To close off the interview, Michael, what is your, if you could go back to your 27-year-old self, I'm 27 now, you could give them one advice, what would you tell them? Like, you have 30 seconds to speak to yourself.
Whatever income you make, take 10% of it and invest it. Every time you get paid, take 10% and invest it in something. Whether it's in real estate, something that's going to make you money and build your assets over time. Because, when you get to my age, and look, I don't consider myself old, spring chicken at 52, you're going to be sitting quite nicely and you're going to be comfortable and you're going to be able to ride out, the crazy markets and the crazy environments we find ourselves in. Economically, famines and food shortages and whatever it's going to be, you can better prepare yourself. So that's what I would say. Invest your 10%. And if you do more, but at least put away 10% every time you get paid.